Okay, super is a super duper thing. Here we go. Joe, should a 17-year-old earning around $1,500 a month voluntarily contribute to super to get the co-contribution from the government?
Yeah, so super is a beast all by itself. And yes, it could be beneficial. So there's a huge benefit, obviously, to starting early with superannuation. So the earlier you can contribute, you get the benefit of compounding. So that is really one benefit of having superannuation contributions. But the co-contribution is that the government will match 50 cents for every dollar you contribute up to the cap. So your taxable income needs to be less than $43,455 to be eligible for the full $500 co-contribution, but you have to contribute $1,000 to get that $500 back. There is a gradual reduction. So between $43,455 and $58,445, it reduces. You also need to have at least 10% of your income coming from wages or business to be eligible for the co-contribution. So yes, if your income is under that threshold and you contribute $1,000, the government's going to give you $500. And for a 17-year-old, that's a handy little boost in the account. If you're able to do that for the next 5-6 years while you're building up, maybe you're studying, got a part-time job, then that's just really going to kickstart you in that whole superannuation lifetime journey.
Yeah, I would not see any reason why Joe wouldn't be encouraged to do that. Meets all the work.
That's all the criteria.
To be honest, it's a great teaching point and a great habit. $100 a month, Joe, bam, into super. Guess what? 50% return.
Exactly. And what are they going to do with it otherwise?
Minecraft, Roblox. What are other
Takeaway,
things?
food. My kids buy food.
I don't even know
what they go and buy.
17-year-olds play and all that stuff. Scott, chat about notice of intent to claim or vary a deduction for personal super contributions. Scott, don't tell me what to do, but let's chat about it. So chat about notice of intent to claim. So what are we talking about here?
So a notice of intent to claim is a form that's lodged with your super fund. It's letting them know how much you want to claim as a tax deduction in this financial year for a personal superannuation contribution. So these are contributions that you've made from your after-tax wages. It's not through your employer. It's not salary sacrifice. This is money that you have paid and you've put in because you're going to claim a tax deduction for it. So you actually need to tell the super fund what it is that you want to claim for them to be able to approve it effectively.
So I just want to unpack that a little bit. The concessional contribution cap is $30,000 for this financial year. If somebody had, round numbers, their employer put in $15,000 as their normal SG employer contributions, they've got a $15,000 leftover cap of the cap. There's a couple of streets that lead to Rome. They could say, I want a salary sacrifice, $15,000, and that happens each month. And then at the end of the year, they've put $30,000 into super at a 15% contribution if they earn under $250, but keep that aside for now. However, if you are potentially self-employed or you might have an offset account and you're like, I just want to keep cash heavy throughout the year and then I'll make some strategic decisions in June each year, you can then say, okay, it's June to 30th of June, I've got $15,000 cap left over. So what we're saying is you can put that $15,000 of your own money into your super account. Then this notice of intent to claim, you log into your super fund probably after the 30th of June and tick the box that I wish to claim personal deductible contributions. That $15,000 has sat in your super account. You tick that box, automatically your super fund will take 15% tax off that. And then your income, if it's a $100,000 a year, you will then effectively, your taxable income isn't 100, it's 100 less $15,000 that you've claimed on tax. It could be less $5,000 for some donations. Your taxable income's now $80,000.
Yep, exactly. So it is.
So both way leads to Rome.
Yeah. And like you said, the intention, what do you want to do with that money? How do you want to use it throughout the year? It's a really good strategy if you want to get some extra money into super. And it's also beneficial because you get to claim the tax deduction too.
Overall, between your personal tax file number and the tax in the super fund, for your life, you'll pay less tax overall. Now, we won't touch on it now because it's less about tax, but it's just a flag that you can look back at the last 5 years and see the gaps. So if you had $50,000 cash and you've got $50,000 worth of unused concessional contribution caps, you can, and that's it, like, and this is, I pulled that thread, Erin. If you sold a property that financial year and some cash landed in your bank account, you could theoretically pay $50,000 or more, some of the profit into super, use those concessional contribution caps to release your overall tax position after the capital gains tax for the property outside super.
Perfect. And it is really about looking at, well, what did I contribute or what has been contributed for me for the last 5 years? And that unused concessional contribution cap is what you can use. So some years it may be, it's such a random figure like $10,152, and then the next year it's $20,392. So it's very specific, and it's important that you know exactly how much of that unused cap you do have before you make the contributions, because the taxing of it is different. So you want to be able to claim the tax deduction if you've got the cash, but that notice of intent is really important, that it needs to be lodged with the super fund. We can't lodge tax returns until
you've done that.
Until that notice of intent has been done. So it's super important to make sure that it's done, and your accountant will ask for it because they're not supposed to lodge a return until that's been received.
I will flag as well, if you've got HECS or HELP debt, if you do the salary sacrifice through the year, you'll get a bill at the end of the year because your employer hasn't withheld as much tax based on your overall earnings. So potentially, if you do have HECS or HELP debt, it might be better strategy to add more to super each year at the end of the financial year. Either way, all roads, we go back to Rome. Hello, Rome, what up? Your tax return and your tax file number, like the business and the side hustle, everything comes out in the wash. I always imagine a funnel, everything at the top, it eventually all comes down, the wash up. What did you earn? How much tax do you need to pay?
Exactly. Yep. And these things will help reduce the tax. But if you haven't had enough tax withheld throughout the year because of the salary sacrifice, you will end up with a tax bill, because that HECS debt, the HELP debt, is calculated based on your taxable income. And so it is really important to be mindful of all of these considerations when you're thinking about, well, do I put extra money into super? How much do I need to put? And what is the overall implication on the tax position?
Meenal, is it still worth putting extra into super if you're charged with Division 293 tax? Do you want to just recap everyone what that Div 293 is?
Yeah, so Div 293 tax is if your income and concessional contributions exceed $250,000, you'll pay an additional 15% tax on top of the normal standard 15% tax on some or all of those concessional contributions you've put into super. So effectively what it means is that the money that you are contributing to super in that concessional contribution is taxed at 30%. And so it's targeted at those higher income earners, because if you're over that 250 threshold, then you pay this additional 15% tax.
Yeah. My own view on this, and the next question that Barbara says, when is it worth topping up your super to get a bit of a tax break? There's a couple of themes with these two things. We don't make or not make strategic financial decisions for our life solely based on what the tax thing is first. So for Barbara, she could be 100% in save mode because I'll make a scenario up. She wants to save as much money because she wants to go to Prague next year for 3 months. So she needs as much money as possible to do that, or she wants to take some leave from the workforce to start a family. So we want to pile cash. It might be more important to pile cash and have it here and pay a little bit more tax than pay less tax and have less cash. Pay more tax and have less cash. Whatever. Did I say that right? Whatever.
It all depends on your circumstances, your personal circumstances. So it's really important when you are considering whether you want to make additional contributions. First of all, look at what your situation is, look at what your income is, and then speak to your financial advisor because they are the ones that can advise on that stuff. But, when is it beneficial to top up that super to get the tax break? And so if your income is over $45,000, you're starting to move into that higher tax bracket, which is 30%. And then you also pay the Medicare levy the Medicare levy, which, you're then starting to think
2%.
Yeah, 2% for Medicare. It then becomes a decision about, well, what is that longer term goal? What is it that you want? It's also great for self-employed people to be putting money into super. We tend to see that super is the thing that drops off first for a self-employed person. But if you are looking for the tax deductions, it's about then putting some money into super because what's the point of working so hard if you're not going to get some benefit out of it? And if you were working as an employee, they would be contributing the super for you. So you are being a self-employed person, it's your responsibility to then fund your retirement. So if you're looking for tax breaks, super is a great one. But it's also then about looking at, well, what is the tax bracket? What's tax effective? But it also comes back to, again, what's the strategy? What's the purpose? What is the idea that you want to be able to fund your retirement, or how do you want that to be? So there is, looking at that tax break, you could use that co-contribution if you're on a low income scenario or your spouse has a low income, making sure that you use that unused concessional cap. That's a great way to get an additional tax break because you're taking advantage of that unused proportion from previous years. It's really important to just look at what your overall strategy is. And if you're getting close to that 250 mark, then maybe it's a conversation to work out whether you should not put in. But the Div 293 tax can actually be paid from the super fund as well. So it doesn't...
Or out of your bank account.
Out of your bank account. So it doesn't necessarily come out of your pocket if you don't want it to. So maybe your strategy is that you put this additional money into super. Yes, you have to pay the Div 293 tax, but the super fund's going to pay it. Overall, that is still a lower tax than what you would be paying in your own personal name. So looking at those marginal tax rates.
Yeah, and for the casual observer, superannuation can get complicated fast, and there's kind of this 3 major tax rates in super, 15% or numbers, 15%, 30% and 0% for pension phase. But there's this 15% internal tax rate in your super that any income generated, it's taxed at 15% internally. But it's also 15% is the tax rate that the government taxes you when you put money in. So to Meenal's question, is it still worth putting extra into super if you're charged an extra 15%? And this also goes to Barbara's question, if I may digress. When we talk about these potential ways to reduce tax with super and I'm going to put more money to super so I can save less tax, so I can pay less tax. Do you have the money to actually put into super? Have you got your budget and cash flow locked away? Have you got your financial goals rock solid? You might have $1,000 in your bank account, but if Rego's due next month, well, no, we've got to pay Rego. So it is about having your system set up and knowing that, okay, I've got X amount left over in my life each month. On this Div 293, if you have all your budget and spending plan in place, you've got your insurances, your sound financial house, you're out of debt, you've got your emergency fund, and you want to build wealth for the long term, if only there was a long-term investment account that was tax effective, already set up, ready to go, aka superannuation, what I'm kind of thinking, and this is my own view, if you are triggered with the 293 tax, your income is over 250, which means your tax rate out of super is 47 plus 2, 49, call it 50%, call it 50. On income and money that you receive, here's a question. Do you want to pay 50% tax or 30% tax? I've taken the view that I'm happy to cop the 293.
Exactly, because it's a lower tax rate. So again, it's important to make sure that, like all of those things you just spoke about, that the cash is allocated. You've got your systems, you've got your processes, you've got your plan in place, and this is surplus cash that you don't need, because remember, when you put money into super, it's locked away until that time when you're able to take it out, which, as you said, super is very complicated, and there's a whole heap of rules as to when you can take the money out and the transition to retirement and all of those things. So it's really important that if you're going to make a contribution to super, you understand that the money's effectively gone. You don't have access to it. So if you can do that, if you're comfortable with that, it's definitely better to look at paying 30% tax rather than 47 plus the Medicare.
Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.